This is a bonus lesson in perfect completion of a corrective wave 4, and that lesson has case studies of gold and GDX, and I would call it do not get trapped by one more lower loss scenario. That bonus lesson will be added to my video course Trade Like a Pro: How to Use Wave Analysis to Find Winning Trading Setups. You may know that I have two video courses uploaded and available on udemy.com, and udemy.com is the largest educational platform in the world. We have more than 20 million students, and if you search for Elliott Wave theory, you will see that my video courses are the highest rated best-selling video courses available on that subject. So we always start our lessons from the main fractal, 5-wave up fractal, that helps us to navigate through the markets. And we will be talking about that corrective structure. It is wave 4. It is a pullback, a temporary correction that follows a strong rally in wave 3 up, and after the completion of wave 4, we still have room to go higher. We still have wave 5 up that has to make a new higher high over the top made by wave 3. This is why it's so important to be able to pinpoint the completion of that ABC down structure. By that moment, the bullish momentum is still very strong. And this is why I love that setup. I love to go alone on a pullback of wave 4 because your risks are limited, your risks of breakdown are limited, but you still have a reasonably large upside potential for ABC up in the final wave 5. Let's go deeper into the microstructure of a corrective wave 4. Normally, it is structured as ABC down, where subwave A is subdivided either into 5 microwaves or into 3 waves, ABC. But in both cases, one of them, that corrective structure we called simple zigzag, and that corrective structure we called ABC flat. In both cases, the final move down in subwave C, ABC, it is subdivided into 5 microwaves. At least this is what theory tells us. And it took me years to realize that sometimes in real life we do not get such a perfect picture. And I know many very professional Elliott Wave analysts and traders who keep getting into the trap again and again. We still expect the real life to be as perfect as textbooks. But at some point, every one of us understands that you either want to trade and make money and you accommodate the real life, or you still try to dictate some perfect rules to the real life, and this is when you normally are left behind. And it happened to me many times. I missed so many rallies because I was waiting for that ever elusive one more lower low. And this is what this video is about. How not to get trapped in that mental trap when you expect the textbook completion of that structure which I highlighted in yellow. Let's talk about our main approaches that could help us to pinpoint the bottom of wave 4. As I've mentioned, wave 4 normally is subdivided into 3 waves, A, B, C. We call them subwaves because they are components of one bigger wave, wave 4. So first of all, we want to get that ABC structure. This is one. Second, we pay attention to the micro counting of the final subwave C down. As I've just shown you, normally subwave C of wave 4 has to be subdivided into 5 microwaves. 1, 2, 3, 4, and 5. So the idea behind that approach, the approach of micro counting, is very simple. So once we start getting that move down, after the first leg down followed by a pullback, we want to get 5 microwaves, preferably making a new lower low under the low made by the first leg down, and this is when we consider that final second leg down completed. Once second leg down completed, that means actually that the whole corrective structure is completed and a new rally should start. In addition to that, we measure the distance traveled by wave 3 and we add 3 most common retracement ratios: 41.4, 50%, 66.7%. What that actually means is that normally in wave 4, price tends to retrace up to 50% of the preceding rally. And this is why it's a great buying opportunity, because normally wave 3 comes as a very strong rally which does not give you many chances to get on board. All pullbacks get shallower and shallower. And this is why wave 4 is much easier to trade for a trader, because once that wave 4 down goes down and reaches some normal retracement levels, you can buy it, because here the bearish pressure is very strong and there is no problem to go long at this point. But you should always remember that any perfect structure, any perfect setup can get invalidated. And this is why the harmonic Elliott wave theory, it's another reason why it's much more superior in comparison to the classic Elliott wave theory, because it has one specific rule of invalidation of an impulsive structure. Specifically, when we have wave 3, it is normally subdivided into A, B, and C, and the low made by subwave B of wave 3 up becomes our critical support. Because the main idea of a trending market, that any trending market keeps making higher highs here, there, and there, and higher lows, it's just a sequence of higher high and higher lows. And this is why when bears manage to violate the previous important law, they get in control, they invalidate potential for continuation of the move higher, because they kill the very core principle of a trending move up. If we manage to break the previous law, it's not longer a trending move up because the law was broken. That means that something changed in the market. That means that for some reason bears got more powerful, and it doesn't make sense to argue why it happened, what was the reason, was it a good reason or bad reason. It just happened. This is the main idea of a technical analysis, wave analysis. So now let's look at the real chart and you will understand what was the problem at the end of September. So at the end of September, early October, we dealt with ABC down structure, and based on pure theory, we wanted to get that perfect microstructure in the final subwave C of wave 4. We got 1, 2, ABC of 3, 4, and we needed another push lower. This is what I call ever elusive one more lower loss scenario. If the majority of the Elliott wave analysts and traders saw that setup, so we have trained the eye, so normally we see, when we see such a clean structure, we don't have problem to quickly identify it independently from each other as a corrective wave 4, and everyone knew that wave 4 needs one more push lower. But the problem here was that here you see retracement ratios applied to the previous rally in wave 3. Remember, I told you we have 3 most common ratios: 41.4, 50%, 66.7. We can see that the drop actually came very low, very close to the critical level. So 66.7% is like no return point. If wave 4 goes under that level, normally from my observations, that means that bulls actually lost control. Once price drops under 66.7%, it is very possible and it is very probable to say that most likely price will not be able to come back up here and make new higher highs. This is why I had doubts about that scenario. So technically speaking, everything looked fine. We got wave 3 down, it looked like wave 3, very strong drop. It came back in some kind of corrective looking structure. It made a lower high in comparison to that high. It looked like a perfect setup for another push down. But normally, if I was looking at wave 5, I would say wave 5 should go here, it should be deep enough. The problem is, if it was going to tag 76.4% extension, that would definitely invalidate the bullish potential of continuation of this rally. That is why I had to consider a scenario where actually it was not wave 3, but it was wave 5, microwave 5, meaning that the whole ABC down structure was completed. This is the alternative bullish scenario I considered at that point, and I shared it with my subscribers. So here you can see GDX 60-minute chart made on October 5th, 2020. Again, under the theory, that bearish structure, that bearish scenario looked much more probable. But as I've discussed, because if it took into account the retracement ratios, it became not that probable. Now we need to understand that trading gold miners and gold together provide you with additional opportunity to compare it to each other, and sometimes gold miners lead rallies or decline, sometimes gold leads rallies or decline, and sometimes, very often, they have very similar counts, and we now watch them together to collect evidence in favor of each scenario. Under the bullish scenario, it was very important that bulls in GDX would make a higher high. Again, remember I told you that because that subwave C of wave 4 was supposed to have an impulsive count, then on the impulsive count, bulls could not get over subwave B of wave 3, because once we get over that level, they would solidly invalidate potential for a new lower low. And this is how gold looked like. Again, in gold, as in GDX, we had the very same dilemma at that point. At the end of September 2020, we got potential bullish scenario where we could count that whole A down, B up, and C down structure as completed. But it did not look like a textbook structure, because under the textbook structure, we would also expect that one more push lower. And in this video, I'm gonna show you how would you approach that problem when you have two different scenarios, both could be valid at that point, and you had to make trade, and you could not make trade because you had very different outcomes suggested by those two scenarios. So let's move forward and see how that story was unfolded in real time. When you have two alternative wave counts that contradict each other, you should keep track on both counts, and you wait until one of scenarios gets invalidated. On September 30th, the bearish count in gold looked perfect. We got ABC bounce, and that bounce stopped well under the critical resistance. And the microstructure of that subwave C of wave 4 actually demanded one more push down. And everybody agreed, almost everybody, that we needed to get one more lower low, and so many traders were shorting that bounce because we expected another push lower. However, bullish scenario also looked good. It did not look great. Why it did not look great? Because that wave 5 was almost equal in size to wave 3, but it was not invalidation of the theory. We prefer that wave 3 has ABC subdivision, but that wave 5 had ABC subdivision A, B, and C, but sometimes wave 5 gets stretched. But you should understand that here we're dealing with a corrective ABC down structure. And when you deal with a corrective structure, you should not be a purist. You should not require perfect microstructure inside subwave C of a corrective structure. It's a counter-trend move. Counter-trend move means that bulls and bears are fighting. Two opposite forces collide. And this is why very often when you do not have one dominant force in the market, you can get very ugly corrective structures. This is why every trending move has clean 5-wave structure, but if to speak about a corrective move, we have at least 8 or maybe even 10 different variations, because the collision of those two forces create much more different alternatives for a corrective structure. So looking back at gold, this is September 30th, 60-minute chart. The bullish structure said that not only we bottomed in that A down, B up, C down structure, but gold has already made the first move up in the microwave 1, so we would expect some weakness here in microwave 2, which was supposed to make a higher low, the first higher low. This is what really matters in the market. We only look for lower lows or higher lows because this is the indication who is in control at that moment, bulls or bears. Now let's look closer at the bearish scenario. The main idea of a corrective ABC down structure, as I've shown you at the beginning of this video, is that the final subwave C of wave 4 has to have an impulsive structure. That means that we have to be able to count 5 microwaves inside that structure. And the bearish scenario did not want to consider that move down as completed. The bearish scenario argued that it was wave 1 down, 2 up, ABC of 3, ABC of 4 with another push down lower. It looked great, but under the harmonic Elliott Wave theory, as I've just told you, we have one specific rule of invalidation of an impulsive structure. And this is an impulsive structure. This is an impulsive structure looking down. That specific rule says that a corrective wave 4 up cannot violate the high of the previously made pullback, and the previously made pullback is subwave B of wave 3 down. If bulls were able to violate even briefly that level, the bearish scenario would have been dead. Let's move forward. This is October 2nd. When gold pushed high again, the bearish scenario technically was still valid, but normally subwave C of wave 4 does not spend much time immediately under resistance. Remember, wave 4 is a temporary pullback. It's supposed to be quick. It's supposed to be very hard for bears to short it. If it goes up in a clean ABC up and then it stalls and starts to hang high right under the resistance, that becomes your red flag. By October 2nd, 2020, you see it started to look very suspicious. It just did not want to go lower. And this is when I started to think more and more that probably gold has already bottomed. October 3rd, it seemed like gold finally turned down, and we can see that the high of that wave 4 was 1923.60, which was only marginally lower than 1925.50, the critical resistance. Okay, technically that wave 4 was valid. Technically, bulls failed to violate that important resistance, but at that point I had very strong reservations against that bearish scenario, again because it spent too much time. It was too easy, too enticing for bears to go short here. And finally, on October 7, after the very first push, very promising push down for bears, look what happened. Gold pushed high again, and then again the first push, actually it was the second push, again did not manage to violate the resistance. It stopped at 1924.90, just 60 cents below the critical resistance level. But shortly after that, another push finally violated that resistance. At that moment, you can confidently say that the bearish scenario was dead. We call it invalidation of the count. And when the bearish scenario was invalidated, we actually were left with the bullish scenario. When bulls managed to push price over the critical resistance at the top of a corrective subwave B up or wave 3 down, you can no longer consider that move up as a corrective wave 4 down. In contrast, after price briefly violates the meaningful resistance, in majority of cases it drops back down after that broken resistance, as if bears try to save their faces. By that moment, we can confidently say that bears have lost the war, but we keep trying to fight and win the next battle. The invalidation of a bearish count does not mean you should expect immediate continuation of a rally. It's great to know, it's a great thing to know. And when it happens, you just wait for a fake move down and then you can go long. Almost never after invalidation of the bearish count, bears can make a new lower low. That last push down, that fake move down, normally can retrace about 50 to 66.7% of the preceding move higher. This is where bears finally give up and bulls take over. Let me show you what I mean. Here we got invalidation of the bearish count. But that did not mean that price would go up parabolically. What normally happens when bulls manage to violate the top of the preceding pullback is that bears try to pretend like nothing happened. Yes, it was a brief violation, yes, but you see that level got defended because, for example, no any single close was made over that line. It just doesn't matter. It's still violation, it's still invalidation, and from that point we understood that we needed to focus on the bullish count. And the bullish count, which is shown on the chart, considered wave 4 down bottomed here, and then it followed by ABC up of wave 1, ABC down that was subwave A, subwave B, and subwave C of wave 2. And I keep telling you that sometimes subwave B in a corrective ABC structure manages to make a higher high over the top of the preceding impulsive move up, wave 1 up. If that happens, you know you deal with a very bullish market. If a corrective subwave B up manages to make a higher high, you know that yes, there will still be one more push down in subwave C, which would complete that ABC down structure. But then underlying strength of bulls will manifest itself and you are going to get a very strong rally. So when you get that corrective structure, which is called expanded flat or running flat, you know that after the final subwave C down, the next move up would be very strong. And by the way, in this particular case, after bulls invalidated the bearish count, they violated that critical resistance, they played that fake move down, which retraced exactly 66.7% of that rally. You see, I highlighted that rally, which we measure, and then we added standard retracement ratios. And this is all what we could do. This is all what bears could do. That was the final exhaustion drop, but we ran out of gas here. We did not have any power anymore to keep pushing it lower. Why? Because it was evident here that bears were not in control anymore. And this is what happened next. This is what we got on Friday. I kept telling my subscribers that this is my primary scenario, and I kept updating that rally all the way when it was moving up. And finally, as you can see, bulls took over and quickly pushed price back over the very same resistance level. And now it's much more reliable breakout. Now let's come back to the chart we started from, GDX 60-minute chart updated on October 5th. Remember, here we had uncertainty because in this particular case, subwave B up, even though managed to make a higher high, so actually it was also a bullish running flat structure. You see, subwave B made a higher high, subwave C made a higher low in comparison to the low made by subwave A here. Again, expanded flat structures and running flat structures are very bullish. They give you insight about what's coming next. And under that structure, we did not have invalidation of the resistance, but because GDX and gold are trading in tandem, they are very highly correlated, we actually could expect that if gold violated the resistance, then GDX would also follow the suit and it would do the same. So this is what happened as of 3 p.m. on Friday, October 9th. Here we can see that GDX opened up with a gap. Very good sign of strength. Remember, I told you running flat gave you a sign that it was a bullish move is coming. And we opened up with a gap and we never even tested the opening price. It kept pushing higher and finally it closed well over that critical resistance. So what's next? When it happens on a micro level, we could conclude that a corrective wave 4 down has bottomed and we have been dealing with subwave A of wave 3. So in my opinion, gold topped somewhere here and we can get a corrective subwave B down, making another higher low. And then a fun should start because subwave C of wave 3 is when rally starts to accelerate. And normally the ultimate target of that rally, which goes off the low made by wave 4, is subwave A of wave 5, the first leg up of wave 5, and it normally targets the previous high made by wave 3 up.